Hello, everyone, and welcome. We're just going to spend the next probably 30 seconds letting everyone get joined in. All right, good evening, everyone. Welcome to the 2020 Tax Planning and Research and Development Tax Credit. We do appreciate everyone joining us this evening from near and far and all the different time zones. My name is Amanda O'Brien. I'll be your webinar specialist this evening. If you have any questions, please utilize the chat function and make sure that it is selected as all panelists, so all of our panelists can see your guys' questions. As well as this meeting is being recorded. If you did not receive the handout that was sent about an hour ago with the reminder, please utilize the chat function and I will make sure you receive that. And without further ado, I'm going to turn our time over to Jim, or Art, gosh, sorry.
Well, you can call me Jim or Art, anything you like. Amanda, thank you so much. And hello, everyone. Welcome. Welcome to our webinar tonight. My name is Art Wiederman. I am a dental director at Eide Bailey, CPA firm, and I'm located in Tustin, California. For those of you who are not from Southern California, probably about 15 minutes from Disneyland. And tonight is the beginning of a lot of great information for the 6 dental societies who have helped organize, and I'm going to mention them here in a second, organize this whole series. Tonight's webinar is on, we're going to give you some updates on the what's going on with stimulus and what's going on with the PPP and the HHS, and then we're going to get into year-end tax planning, and we're going to introduce many of you who have not seen this to the research and development income tax credit, which is becoming a tool that many dentists are able to use. So the first thing I would like to do is I want to thank, just kind of tell you how this all came about. I was talking to Kristen Avina from the Harbor Dental Society, who's their executive director, and we were talking about the fact that they and some of the other dental societies wanted to put on a webinar series for dentists and give out a lot of information on the business side of dentistry. And after lots of conversation and lots of Zoom meetings, and we put it together, and this is the first meeting of this. So I'd like to thank the 6 dental societies that are participating in this. First, we have Kristen Avina, who's the executive director of the Harbor Dental Society. Megan Francis, Megan is wonderful, thank you, from the Orange County Dental Society. Michelle Schneider, who's the executive director of the West Los Angeles Dental Society. Greg Orloff, who's the executive director of the Los Angeles Dental Society. Lee Addishin, who's the executive director of the San Gabriel Valley Dental Society, and Kurt Thornton, who's the executive director of the San Fernando Valley Dental Society. All 6 of you have been absolutely incredible and wonderful, all wanting to really help the dentists in our community during this challenging 2020. So we have a slide on what we got coming up for you, but we got a lot of information. So Amanda, let's go to this, and I'll be introducing our guests here as we get to that slide right at the front. So let's go ahead and put the PowerPoint up and get started. Okay, Amanda, I think she's muted. Oh, there we go. Thank you. So I'd like to introduce my guests and my panel tonight. So as I mentioned, I'm Art Wiederman. I'm a dental director at the CPA firm of Eide Bailey. Eide Bailey is sponsoring all of these webinars. We're going to have a total of 19 webinars. You're going to get sick of me by next December, folks, but we got a lot of stuff going on. We have 2 of our incredible team members from our research and development tax credit team. Jim Donovan, who's a partner at Eide Bailey. Jim is out of Iowa. And Heidi Lannon, who's a senior manager. She's out of Arizona. So Heidi and Jim are going to present in a little bit on how the research and development tax credit affects dentists. And then I have my partner in crime from the beginning of this whole thing, my good friend, Megan Mortimer. Megan is a congressional lobbyist, one of 4, for the American Dental Association out of Washington, D.C. And she and I have done, Megan, 20, 25 webinars together. We have never met in person. We're on opposite coasts. And we look forward to the day that life allows us to do that, probably at our next Academy of Dental CPA meeting. So that is who your presenters are tonight. So let's go, Amanda, to the next slide, please. So what I want to share with everybody is that we're going to be doing 3 different tracks coming up here for the next year. We're going to be starting, we're starting tonight, and then in January, make a note for the second Wednesday of each month that we're going to be doing a called the Business of Dentistry, a series for success. So in January, we have an incredible dental consultant out of Reno, Nevada named Kira Dent, who's going to kind of get everybody going for 2021. And then we have marketing, we have cybersecurity and internal controls, retirement, financial planning. We're actually going to do one webinar where we actually go through the metrics of dental practices. What does it mean if your reappointment percentage is not 85%? We're going to go through that. We're going to talk about hygiene. We have a lot of really great stuff. So that'll be the second Wednesday of every month starting in January. Then all the dental societies wanted to do something on transitions. So we're going to do a 4-part series, which is going to be on those dates, as you can see, January 20th, February 17th, March 17th, and April 21st. We're going to talk about the legal side of transitions, the valuation tax side, management consulting, what to look for in the management of your practice if you're buying or selling, and then the finance and banking side. And then we're going to do on January 26th and February 23rd, a track for new and prospective dental owners. We're going to talk about, what do you do with QuickBooks? How do you set up your systems in your office? We're going to have Fortune Management's going to help us with that. We're going to have Anita York, who's spoken to many of your dental societies on what do you do when you hire an employee? So we're going to talk about that. So we got a lot of stuff coming up for you. And tonight's kind of the kickoff. So let's go to the next slide. Okay, so here's what we're going to cover tonight. Where are we seeing dentists' incomes for 2020 as compared to 2019? What's happening is we and our CPA firm are now looking at year-end tax planning. This is what we do in October, November, and December. And we're looking at dentists' incomes, and we're going to go over where you are. And if you didn't look at your numbers and you think, oh my goodness, there was a pandemic and I must be down 50%, I think you need to look a little closer. We'll talk about that. We're going to talk about pending legislation, which Megan is living this nightmare every day in Washington of what's going on. And I think, Megan, I just wish they would just tell us what they want us to do, right?
Oh, you're from your lips to Senator McConnell and Speaker Pelosi's ears.
Yes.
But yeah, I mean, we're just continue to wait. Hurry up and wait for them to decide at the last minute.
Well, we'll talk about that. I'm going to give you a little update on PPP and HHS provider relief grants and loans, how they affect income, deductibility. Then we're going to get Heidi and Jim on to talk for 15, 20 minutes on research and development. And then we're going to get into tax planning. So let's go to the next slide and let's get going. So where are dentists' incomes today? Where are they? What we are finding is, and let's do a little history here. So for the first 10 weeks of the pandemic, which started the week of March 16th, dentists were really, they were closed down. And then they came back and they were doing really well. I mean, my dentists were they were closed for 8 to 12 weeks, except for emergency procedures. 90% of the dental offices in the country closed down. Most offices, as you all know, opened between May and June. Due to the pent-up demand, I have clients that were telling me they were at 100, 110, 120% of where they were, even with the social distancing, because everybody needed to get in. Lots of offices continued to pay their employees with PPP money, but offices also furloughed and laid off employees when they were closed down. So, because employees were making more on unemployment with $600 a week. We all know this. So, basically, we have a lot of doctors who are down maybe 10 or 15% in their revenues, and they weren't maybe paying a lot of expenses. They weren't paying lab, they weren't paying supplies. Let's go to the next slide, please, Amanda. Lab and supplies were down. Many of you got the HHS provider relief funds, 2% of your revenues. We'll talk about that. And at the moment, PPP expenses are not deductible, but we'll talk about that. So what we're seeing, folks, and what I want you, what the whole point of this is I'd like you to, you really got to meet with your CPA or your financial advisor, because we're finding that many of our clients are not down more than 10 or 15% from where they were in 2019. And we had one client that remodeled their office, big office. And I said to them, I said, you understand, you don't have $450,000 of bonus depreciation. So you're actually up. And they were looking at me like I was, speaking a foreign language. And so, in many cases, we're seeing that taxable income is up, especially since at the moment, these expenses for the PPP are not tax deductible. And what's happened is many of you operate as an S corporation and you take salary, and that's how you pay your taxes. And some incorporated dentists, we've talked to a lot of our clients, either stop taking salary or cut their salary back and cut their withholdings back. So if you're an S corporation, your income could be higher. That's all I'm saying. What we're seeing is with the PPP expenses at the moment not being deductible, many of our clients are at or near where they were in 2019. So the whole point of these slides is very, very important that you sit down with your CPA and your financial advisor, if you haven't already done it, in the next 21 days before, what would that be? Yeah, in the next 22 days, actually, to make sure you see where you're at. Okay, so let's go to the next slide. So, Miss Megan, I'm going to bring you on here, pending legislation. So this was as of December 5th. And of course, everything has changed. So I'm going to turn this over to you. Why don't you let everybody know? I think everybody, including SpongeBob and the Minions, have a bill out there that they're proposing, right?
Yeah, I think the Minions have two. I'm not sure.
Yeah, exactly. It's Kevin's that I like, actually, but go ahead.
But in all seriousness, people have put forward a number of proposals, but the one that's rising to the top, the one that everyone's kind of using as their base framework for negotiations, is this bipartisan, bicameral bill that's being put forward by members of both the House and the Senate, Republican and Democrat, and also being spearheaded by a caucus that we call the Problem Solvers Caucus in the House, which is a group of about 50 or so House members from both parties. They're equal representatives that always try to come together and try to find compromise on legislation, hence the problem solvers nomenclature. So this bill is being touted as what they're using as a jumping off board. We can get into the specifics on PPP if you'd like, or we will in slides. But the outlook for now is that talks are still ongoing. We get closer and closer to negotiations, and then someone decides to pull back. This is kind of the dance that always occurs. We wish it wasn't still happening this late in the game, because they have until December 18th to finish up everything. Even though they would have liked to have left a lot sooner, they're not going to be doing that now. There was an earlier plan to leave December 11th, but that's not happening. And as we saw with the spending bill, they also kicked that for another week so that they could have another week to negotiate on some specifics there. So today the House voted to kick the spending for another week because it was supposed to expire this week. So they have a little bit more leeway with the days left to negotiate. And the COVID relief talks are wrapped up in those as well. So again, Mitch McConnell gave a little bit yesterday saying he didn't have to have liability protections in there, but he also wanted to pull out state and local funding, which is just a no-go for the Democrats, because they know that they're hearing from home that is the biggest issue, is the state and local governments need extra funding. And liability is, a very big sticking point for a lot of Republicans who want to go forward with this. So McConnell removing that is a no-go for many Republicans as well. So we have that. We are also still a little bit stuck on unemployment insurance, how long to extend it, how much to give in extra federal money every week. And then stimulus checks have reared again in terms of there's both Republicans and Democrats asking for an additional stimulus checks for individuals and households. So again, we can get into the specifics of the framework on our issues, but that's the lay of the land as of now.
And so this $908 billion bill, Megan, which is the one that was the first one to come out, because as I know, Senator McConnell's got one, and now the White House came out with a $917 billion bill. And so we got three, but the one that's got, as far as you and I have talked, the most traction is the one from the, what was the group that you called them?
Well, it's spearheaded by the Problem Solvers Caucus in the House, but there's also Senate leadership that is also, working on this with their colleagues, in the opposite chamber and in the opposite aisle. So it's bicameral, bipartisan, but yeah, problem solvers are probably like the biggest swath of legislators that are really pushing this.
So in this bill, which they just yesterday or the day before came out with the details on, this includes $288 billion. And I thought maybe that number might have changed closer to 300, but it's about $300 billion for another round of PPP for businesses who had significant reductions in revenues. Now, I put in this slide between Q2 of 20 and 19. But after I put this slide together, which always happens, they came out with a summary, Megan, that said it wasn't in any quarter of 2020 as compared to any quarter of 2019 if your revenues were down more than 30%.
Yeah.
Now, none of us have seen the details, the actual bill itself. So I'm sure they're not just going to hand over money to everybody, but it's going to be Q2 for everybody on this call and elsewhere who are going to possibly benefit from this. And, we don't know how much they're going to give out. Remember that the PPP was $349 billion and about 130 of it didn't get spent. So they funded about $220 billion out of this. If they're putting up about 300, I would suspect that a lot more businesses, if these rules are favorable, are going to go after this because obviously people were not as maybe worried in April as they are now after 9 months, where we see that we have 15 million people who've gotten this virus and close to, horribly 300,000 people, almost 300,000 lost their lives. And so now I think a lot of businesses, restaurants and others are going to go after this. So for those of you on this call, start gathering a little bit of information, just see if your revenues were down by 30% in the second quarter, which for most all of you, unless you stayed open, you were. I don't see how you weren't. And so the other thing, Megan, that's in this proposal is the simplification of the PPP forgiveness process. So talk about that a little bit.
So we, along with a number of other stakeholders, have been asking for ease of forgiveness for loans that are $150,000 or less to make it a one-page, simple, easy to fill out, pretty much just an attestation that you would provide, SBA Treasury with your payroll, proof if you had to. But other than that, filling out a laborious application and having to have the lender process it. And that's gotten a lot of strong bipartisan support because frankly, SBA and the lenders don't want to have to go through 3 or 4 pages of application, even though it's much shorter than we originally had, 11 down to 4 for the easy, which most of our members will be able to use. It's still a pain. And again, we're not going after the people who got $150,000 or less on these loans in terms of oversight and auditing, right? We want to look at the larger loans, the 2 million plus, which you probably heard now requires an additional questionnaire to attest that you actually didn't have access to other liquid capital. So that's in this proposal. As you've noted here, SBA and Treasury decided to ease the forgiveness for loans that are $50,000 or less. So we know that they have the capacity within them to expand this to 150. This would just be Congress kind of mandating that moving forward. And I imagine it would be the same rules for the new round of PPP loans. Those wouldn't change. They would remain the same.
I suspect that the banks are lobbying very hard to make it simpler because there's 5.1 million applications out there. And I would think that you could probably count on one hand the number of people that are not going to apply for forgiveness.
Right.
So, all right, let's go to the next slide. Okay, so let's talk about PPP and forgiveness. So just real quickly, because Megan and I could spend 2 days on this. You got a loan, it is forgivable if you check 3 boxes. Number one, if you spend at least 60% of the money on payroll, limited to $20,833 for most cases, the doctor or anybody that makes over $100,000. Number two, and you have 24 weeks now to have spent this money. So most all of you are going to spend more than 100% of your loan amount on payroll. So you're going to mostly all check this box. If you have to have the same number of full-time equivalent employees on the earlier of the date you filed for forgiveness or December 31 that you had at the beginning of the year. However, none of you, unless your revenues are up this year, are going to have to worry about that, because there's a rule that says if your revenues are down because of COVID-19 and the CDC has said that you suggested that you be shut down, or local agencies, that you basically are going to be able to ignore this rule. So the only rule is if you have reduced hourly wages or salaries by 25% or more during your covered period, as compared to the first quarter of this year, you could have a small reduction. The bottom line is when you do the math and you fill out the forms, even if you did lay some people off, unless you laid off everybody, the amount of money you've paid in wages is going to trump whatever you are using for have as a reduction, and therefore you're not going to have a reduction. So unless most of you have eliminated all of your employees, you're more than likely going to get full forgiveness. We've had people, we've started filing for forgiveness. The banks are moving these through really quickly. And the SBA, Megan, seems to be, they're starting to work on them, right?
Yeah, I mean, I'd like to caveat that with a couple of things, Art. For us, we're still recommending our members, if they can, wait as long as possible, just in case there is congressional action or different regulatory action. Even if it happens in the beginning of the year next year with a new administration, most people, because it's the 10 months after their forgiveness period, will have until late March at the earliest, or April, to have to start thinking about filing for forgiveness. So that's one thing.
Right.
And then, I mean, again, with the with everything going on with the banks, I will say some of them are good at it, but as you and I both know, there have been some lenders that are dragging their feet a bit with processing. I'm not going to name any names, but we're getting some complaints from members that have decided they want to file because they're retiring, because they're selling their business, or for whatever other reason they need it off their books. And so it's inconsistent, as you know. They should be ready to go. SBA wants them to be ready to go, and they want us to report on lenders that aren't, but some of them are still very much waiting for Congress or the administration to act to make this easier on them.
They were supposed to accept by August 10th. So right. Let's go to the next slide. Yeah, so basically there is really, and I think I have this on a slide, Megan's absolutely right. I was just kind of going along here, there is no rush to file, and there's a slide on that. So basically all dentists will blow by the 60% rule. None of my dentists cut employee salaries. The dental profession are some of the kindest human beings I've ever met. And I've not heard of one of my clients saying, oh, well, we're in a pandemic, I'm cutting your salary from $25 an hour to $22. We just, Megan, we don't hear that, right?
I don't hear that, no. If anything, they're like, please let me know what I can do to keep my employees on. I want to bring them back.
Exactly. So you have 10 months, as Megan said, after your 20-week period, which is going to get you to probably July, August. If you're under 50,000, it's a slam dunk. You can ignore the FTE and the 25% rule. And as Megan said, there's a real possibility that they're going to expand this easy filing to 150,000 or less. I don't really see a need. I have had some clients, Megan, who have said to me, Art, I'm afraid of what's going to happen. I'm worried that they're going to change these laws and blow up forgiveness. You've heard this too, right, from some people. And if you are worried and you've met all the rules, then you can file. We're just saying there's no reason to rush. Let's go to the next slide, please. So For there's reasons, like Megan said, there's no rush to file unless if you're selling your practice, you must file for forgiveness before your practice sale closes. Or you think the rules are going to change to your detriment. There's nothing that Megan and I have heard that's going to happen. Or if you believe for some reason you're going to have to lay off your employees before the end of the year. People were worried here in Southern California, Los Angeles County especially, with the governor's shutdown or stay-at-home order, that there was going to be a problem. But if you go on the CDA's website, you go on, I've checked several of the local dental societies that you're members of. It's very, very specific. Dentists are not having to shut their offices, period. So that is what we've heard. Let's go to the next slide. So deductibility. So back in May, the Treasury said that if you got forgiveness from the SBA, you couldn't deduct the expenses. And from a tax preparer standpoint, I've been doing taxes for over 40 years. And if I get non-taxable income and I spend it, the tax law says that those expenses are not deductible. That's all well and good, but that's, Megan, not how this program was sold to the American business public, right?
Nor to Congress. Congress did not intend for this to happen. They're all upset at IRS for making this decision. For the first time I've seen since I've been doing tax work, they're all coalescing around one issue and screaming at IRS about it. But Mnuchin's dug his heels in, so it has to be a congressional act now, as opposed to he could just reverse it if he wanted to.
Right. So basically, with the expansion to 24 weeks, you see, they all thought in April that everybody was going to, it was an 8-week period. They were going to file for forgiveness and we were going to be done. Well, now it's 24 weeks and you have 10 months to file for forgiveness. Nobody is going to get forgiveness, virtually nobody. And I'm guessing, out of the people on this call, maybe somebody's already gotten it. That's great. But most of you are not going to get forgiveness before December 31st. So let's go to the next slide, Amanda, please. So 3 weeks ago, Treasury clarified their position. And they said that, quote, if the PPP borrower has a, quote, reasonable expectation of forgiveness, the expenses are not deductible in 2020. So when we're doing our tax projections, and I know that there's many of our clients are on this webinar, we have added back your $75 or $125 or $60,000 PPP loan that you spent on wages and rent and interest and utilities to your taxable income, and just said, plan on paying taxes on that. As Megan said, very serious bipartisan support to make these expenses deductible. I mean, Megan, there's no reason that anybody on this call shouldn't write their congressman or congresswoman, senator, House representative, and just say, hey guys, we would really respectfully request that you make this deductible because that's why I took this loan out, right? There's no reason they shouldn't do that.
Yeah, and I can make it easy. We just did a grassroots alert last week that includes all of our asks for PPP. This is the #1 issue that we're asking for Congress. And so in the chat, I'll put a link to our grassroots alert and it'll just automate an email for you. You can edit it if you want to, but it'll just automate an email for you when you put in your address and your zip code to your congressman and your 2 senators.
And that's why it's wonderful that we have young people who know how to use computers on these webinars. So that's good. Okay, next slide, please. Okay, let's jump to the HHS Provider Relief Fund. Many of you applied for this money. This money was $175 billion that was intended to fight COVID and to be paid to healthcare providers to fight COVID. And basically, dentists were not included in any of this because, Megan, I think you told me they really didn't know what to do with the dentists in this whole plan, right?
Yeah, they, dentists can be often an afterthought. And so what we decided to do from the get-go when we saw this provider relief fund rolling out and noticed that we weren't included was we started fighting right away. First, we were fighting for Medicaid dentists because they were experiencing an influx of patients in some instances and then less in others. Some of them work at FQHCs, et cetera. But we really didn't understand why they didn't consider us essential healthcare providers. And so we fought our way in, and HHS decided they were, of course, wrong and reversed on that decision and decided to include dentists. But the first swath was just to frontline providers. But then after that, us along with other stakeholders wanted to push it to all of us to provide,
So here's what you need to know, folks. In January, the Department of Health and Human Services is going to provide a portal that is going to be, again, early January, so they say, okay? And I spoke to Tyler Bernier, who is our HHS expert at our firm here at Eide Bailey. He's in Oklahoma City, and he walked me through all of this. So basically, you want to start accumulating your invoices for your PPE, all the stuff you spent, money you spent on UV and air purifying machines, and any other expenses that you paid in 2020. You're going to have until June 30th of this year, of next year. I'm sorry, that's a mistake. That should be June 30th of 2021. I apologize, to spend the money. If you want to go to our website, which is www.eidebailey.com, we have up-to-the-minute updates on this HHS Provider Relief Fund rules, and we have webinars that we're giving on this, and we'll try and blast that out to all of you. Next slide, please. So basically, next slide, if you could. Okay, so you should not have any trouble justifying this. You're going to have to file on this portal by February 15th. Mark that down, February 15th. So here's an example of how this is going to work. So Dr. Wiederman's dental practice got an HHS Provider Relief Fund grant of $20,000 based on 2% of my $1 million in 2019 revenues. So my revenues in 2020 are down about 15%, which is about right, given everything that's going on. I also got a PPP loan of $90,000 and an EIDL grant, which does not have to be paid back, as opposed to the EIDL loan, which is $150,000 that does have to be paid back. I spent $10,000 in 2020 in additional PPP expenses, N95, face shields, gowns, etc., and $5,000 on an air purification system. So 2 ways we justify this money. Number 1, expenses used to fight COVID-19. Folks, that's your PPE, okay? Now, it's only your incremental PPE. So here's an example. Before COVID, most all of my dentists would wear a paper mask, and their teams would wear a paper mask, hygienist, the dental assistant, and gloves. Now with COVID, it's a paper mask, it's an N95 mask, it's a face shield, and it's a gown. So only the last 3 items, not the paper mask, is allowed to be used for this calculation of using this money, okay? They also tried to get, basically, they tried to get the $5,000 I spent on the air purifier. They basically tried to say, oh no, you have to depreciate that. Well, that got blown up in about 30 seconds and they changed that rule. So we got 2 ways we justify these expenses. So let's go to the next slide, which I hope is on here. Should be a mathematical example. There we go. So I got $20,000. I spent $10,000 on the PPE expenses and $5,000 on purification equipment. So there's $5,000 I haven't spent. The next thing you're allowed to do is to take your reduction in revenues between 2020 and 2019. I went over this with Tyler today. So Dr. Wiederman collected $1 million in 2019. In 2020, collected $850, but included in your revenues have to be any government grant program money that you got. Also includes if you got money from the County of Orange or the City of Long Beach or something like that, okay? So the total revenues for this calculation are $950,000. So I have an additional $50,000 I can take into account to be used for this particular calculation. So I'm only 5,000 short. I could buy a bunch more PPE. I've got till June 30th of next year. So since I was only short by 5,000 and I have up to 50,000 in a cushion with my revenue reduction, I'm going to be fine. Most of you are going to be fine. You're going to go onto this portal. Megan, there is one of your lobbyists works on this, right? I think. And
yes, my fabulous colleague David Lynn is the lead on this, but I handle the tax aspect of it on the congressional side. So we work tandem on this issue depending on whether or not we're dealing with the agency, the Department of Health and Human Services, or whether or not we're dealing with Congress.
Right. So, again, I want to remind everybody here, I've been working as a dental CPA for 36 years. Never had a ton of interaction with the American Dental Association. until March. And then I met Megan and I met her boss, Michael Graham. And I had the honor to interview on my podcast, which I'll tell you about at the end, Dr. Kathleen O'Loughlin. You are well represented by the American Dental Association, folks. These folks are fighting very, very, very hard for you to try and get you this PPP deductibility, along with all the other fighting by your side, Megan, the restaurants and the accountants and the lawyers and everybody else. Megan has worked tirelessly. I mean, everybody, Michael is amazing. Everybody at the ADA is amazing. If you have questions, Megan, they can reach out to you and email you. You've helped how many of our clients? I mean, with a problem? A lot.
As many as will call me. I mean, look, or email me. I'm here for it. I've been starting to answer CPA questions, not from you guys, of course, because Eide Bailey and you are an Eide CPA are all on top of it. But I'm getting more calls from accountants now that I am our members asking me questions. And
Megan and I go back and forth. I answer her questions. She answers my questions. So anyway, let's move on. I got a lot of material tonight. I want to get to all of it. So that's the HHS Provider Relief Fund, folks. Just be prepared to start planning on providing information, gathering your expenses sometime in the next 30 days. We don't know what this portal looks like. There is on the frequently asked questions on the HHS, and HHS stands for the Department of Health and Human Services. On their website, there's a whole bunch of frequently asked questions about what it is that they're going to require. Go on and look at that. And we'll be happy to help you here at Eide Bailey, as is Megan and the folks of the ADA. Let's go to the next slide, Amanda. Okay.
Only thing I want to end with is
ahead.
a couple of questions that we got in the chat, and then we'll.
No, that's right. I want to, before we go to Heidi and Jim, let's go to some of the questions in the chat. That's right.
Not a ton of questions. I think we answered that. One is from, I want to say Dr. Level Danilo Chavez, and says dentist did not get that right. I don't know what you're referring to. So if you could just clarify what you're referring to and what they did not get. But I did have a great question from Jonathan Fetter, probably Dr. Fetter. I apologize. I always want to refer to our dentists as doctors, asking about the Eide grant. So this has caused some confusion as of late for our members and maybe some of your clients. But the Eide grant in relationship to the Eide loan does not have to be paid back. In relationship to the HHS Provider Relief Fund, those two things are mutually exclusive. They're different programs. However, the Eide grant was the first thing to roll out. It was the first pot of money that the government wanted businesses to take advantage of to stem the bleeding from COVID shutdown. But then they also caveated that if you decided to get an Eide grant, which a lot of our members did, but then you subsequently applied for the different program, PPP, got a large amount of loan forgiveness money, they wanted to deduct the Eide grant from your amount of allowable loan forgiveness. So say you got a $100,000 PPP loan, you file for forgiveness, you meet all of the standards. If you got an Eide grant, you're only eligible for $90,000 in forgiveness. They did this for a couple of reasons. One, they're separate programs. They need to be funded separately, and Eide deals with all sorts of disasters, not just COVID. Hurricanes, earthquakes, fires that occur. And so they need to have a pot of money for the businesses that are affected by those that are still ongoing. As you guys know, in California, fires did not end just because COVID came forward. And so they needed to, replenish those funds. That was one of the reasons. And the second is for, kind of financial hawks. Their idea being, if we gave you a large amount of free money and then you got another larger amount of free money, we should be able to deduct that amount from the forgivable PPP loan. So I want to clarify that. Thank you, Dr. Fetter, because that's caused some confusion as folks start to apply. And then the HHS Provider Relief, Dr. Levodinol Chavez just asked, yes, dentists we're definitely able to apply for the Provider Relief Fund. Unfortunately, the time to apply for that has ended. But in this bill, in this bipartisan relief bill, there is talks of reopening that back up and replenishing it with even more funds. Yes, that's one of the things that I wanted to note as well.
I did not know that.
Not apply in the beginning does not mean that you won't maybe have a chance moving forward if we're able to move forward with this bipartisan package. So those are the only questions I saw. I'll leave it at that and I'll stop talking.
Oh no, we like when you talk because you give great information. And folks, be assured that we at Eide Bailey are going to go ahead when something passes. We were doing webinars in April, May, June, every single week. We're going to be doing some more for our clients and we'll keep you all posted. All right. Let's get to something that's really exciting. when you're a tax guy, different things are exciting, R&D tax credits. So my job is to run the federal deficit into a hole. That's what I want to do. And my friends Jim Donovan and Heidi Lannon are going to show you how a tax credit for research and development activities apply to dentists. So, hi Jim and Heidi, how you doing tonight?
Wonderful, Art. Thanks for having us. We really appreciate it.
Well,
Yes,
I'm
thank
going
you.
to do something that's really difficult for me, which is I'm going to be quiet and I'm going to listen. So the floor is yours. When you want Amanda to change a slide, just ask her to change a slide.
Awesome. Thank you, Art. Appreciate it. And I think Amanda gave me control here. So
Oh, okay.
there we go. Oop, and I went too far. Well, I tell you what I'm going to do is I'm going to start at a 30,000 foot level, give you guys just a little bit of background on the R&D tax credit and how it came about. And then I'm going to let Heidi dive into specifics and really some examples of how it applies to your industry. And then we'll come back and just kind of bring it all together for you. So with that, I'll kind of hop into the R&D tax credit, which has been around since 1981. For a large period of time, it was an expiring tax credit, which meant every couple of years, I wonder if I have a job. But in 2015, it became permanent. And so when you talk about the credit, everybody always asks, hey, what's the bottom line, right? And so it is a tax credit, which means it's a dollar for dollar offset of your tax liability. And the benefit is 5 to 8% of your qualified research expenditures or your qualified costs. So it's 5 to 8 cents for every dollar we find that is qualified. And that's your federal benefit. There are state credits available. In this case, we're talking about California, and there is a state credit. What I will tell you is California has a very old model of the credit calculation, so it's a painful one to compute. You may have to go back into the 1980s or the 1990s and pull historical financial records to actually compute a credit for 2020. So it's not an ideal calculation, but it does exist. I will also tell you that, hey, if you're a new company or a startup, there's an opportunity to offset payroll taxes with your R&D tax credit. When talking about, gosh, hey, I'm interested, I want to do an R&D tax credit study, I want to take advantage of the credit, what does that look like? For most of our clients, it's just a calculation for the current year or a study for the current year, so they can get a benefit for their R&D activities in the current year. You can look at all open tax years, so you can amend prior tax returns. But what I'll tell you is there's risk associated with that, right? And so you have to be willing to accept that risk. It's just not recommended because once you start amending returns for the R&D tax credit, your likelihood of being audited is higher, right? So please be aware of that. I guess the last thing I'll mention, at least for federal purposes, if you can't use the R&D tax credit in the current year, it does carry forward for 20 years. And so again, it's available. You're not going to lose it. All right. In terms of typical industries where we see the R&D tax credit, software development, manufacturing, right? As they bring things out, they newer, improved products, technology, hardware, food and beverage, life science and pharmaceuticals, agri-science, agronomy, aerospace, defense, engineering. You guys aren't shocked by this, right? And you're like, okay, that makes sense. That's where the R&D tax credit was intended, right? So, kind of flowing along those lines, we'll talk about some typical qualified activities, newer improved products, which, you look at, gosh, what's put out on, stores all the time. It's always a new product or an improved design, right? And this can include molds, tooling, dyes, fixtures. There's research around raw materials, right? What am I going to use to make this product? Then there's, of course, the process development, automation, robotics. It's all about how can we make things faster, cheaper, to tighter tolerances, right? So there's a lot of R&D in the manufacturing process world. And then of course software, right? What's marketed to customer, what's internal use. You have a lot of big companies that are developing back-end software that can qualify for the credit. Some of the other things we see are engineered designs, genetic development, Just again, these are things that are not going to shock you, right? These are where you would expect to see R&D. So really at a 30,000 foot level, you're saying, gosh, there's a lot of opportunity for R&D. Now let's take it down a little bit lower, and Heidi's going to hop in here and talk about what is a business component.
Yeah, and so, Jim talked about typical activities, and that's really what we think and we live in the credit world that the credit addresses. So now when we turn our attention to dentistry, obviously you're thinking, how does this apply to me? So I want to start with this first concept of a business component, and hopefully this helps frame the conversation to get you started about if this applies to you or not. So the law states that you can potentially claim an R&D credit based on your business component, meaning that this is a product, an invention, a technique, things of that nature. I want you to focus on product because this is the fact pattern that is probably going to be more defensible for you than a process. So when we're talking about product in your world, we focus on crowns, dentures, the different devices. That's what you're actually providing the patient. That's your business component. So when you're thinking about procedures, a lot of times those procedures are routine, and like fillings and things like that. Those are not what we talk about when we talk about business components. So just kind of keep that in mind as we start talking about your industry. Now, certainly if you've developed an advanced technique that's not being done by anyone else, this is very unique, it's specialized, and importantly, you have a systematic testing process as you're developing it. That then could be a business component. Next slide. There you go. So we can talk all day about you qualify or you don't qualify, and once we figure out, yes, you have some activities that meet that business component test. Now we want to talk about what amount of the credit are we looking at, because certainly we all think about ROI or cost benefit. If I'm going to pursue the credit, yeah, there's an advantage to putting that on my tax return and not paying a lot of tax, but is it enough? Is it big enough to go through all that effort? And so let's talk about some of those costs. So really the credit is driven by wages. That's going to be where we like to say bang for your buck is. And so, this is measured by how much time are you spending on these activities that we were talking about, those business components, the customization of a business component. So, there's a 4-part test that I'm not going to get into right now, into the weeds. It's certainly very important, but we've got some other material we want to cover. But the most important thing that I want to tell you about is the 4-part test is, when we're determining your time involved, there has to be uncertainty. There has to be something that you're uncertain about. That what is that? That could be, am I capable of even doing this? What methodology am I going to employ? Or what is this going to look like? What's the design? When I have a patient come to me and they have an issue and I want to resolve it for them and give them a product or a device, what does that look like? So uncertainty is very important. And then we'll talk a little bit about process of experimentation. That's another one of the part of 4-part test. That's really important as well. And so, there's some supporting employees as well who we can take a look at. Those are your lab technicians or dental assistants who are helping you with complex cases. We don't see dental hygienists being claimed very much. They're more involved in routine activities, cleanings, things like that. Now, going to the second and third, bullets here, we've got supplies and we've got contractors. So let's talk about supplies a little bit. So let's say that you are developing a custom product or business component. So let's say that's a crown, or it could be a series of devices that are interacting with each other. You probably are making a prototype. So that is a supply, those supplies that you're using to make that prototype. And it has to be consumed or used up in the process. One thing to think about, I know a lot of you talk about, your machinery and equipment that you've purchased that you can do milling in-house. The actual equipment is usually expensive and it's being depreciated over time. So these supplies have to be expenses, not anything that's being depreciated. So that's a very important thing that I want you to keep in mind as well. And then finally, the contract research. This is, where you're doing testing. Maybe there's some field trials that you're working with another company on. Any third parties that are maybe testing your prototypes for you. So that's something to keep in mind. That, we can only claim 65% of those expenses. So that's why I say this is a wage-driven credit. It really is about what do your wages look like? What are you paying your people and what percentage of time they're spending?
Heidi, let me ask a question real quick. So why don't you know, go ahead and go through the dental practice activities, and then I have a question for you. Go ahead.
Okay, perfect. So when we talk about customization versus routine activities, that's a really important thing that we have to identify when we're claiming your credit, because right, we want you to be able to substantiate it if you have any questions in the future. So these are some of the unique case solutions that we've seen that are a little bit more defensible when you have the IRS or some state agency come and ask you questions. If you're if you're using different multiple devices, so crowns, bridges, implants, spacers, and you're trying to design them and make them work properly together to achieve the goal, this would require examining many different options, right? We see restorative care. So cases with trauma that someone comes to you and you have to be creative and figure out how you're going to help them. The other thing is different materials. So you may have a choice of using new plastics or metals or porcelains, things like that. So again, we're talking about those alternatives, those I don't know what this is going to look like. I don't know what this is going to consist of. Implants, bone grafts, the last bullet is really, it sums it up. You have to be thinking about, these different alternatives and hypotheses are probably increasing durability or making it safer, smaller, smaller mouths. Sometimes you want to achieve the same effect, but you've got to make it smaller. So different things like that. Art?
So I want to throw this out. So a lot of the doctors that are on our call, they do some really advanced continuing education. I'll mention the names of the organizations because they're not a secret. And they're all wonderful organizations. The Coy Center in Seattle, the Scottsdale Center, Frank Spears Group in Arizona, where you are, Heidi, the Pankey Institute. These are organizations, LVI. These are all organizations that teach advanced techniques to dentists. So maybe Heidi and Jim, a little guidance, like, let's say somebody is taking, I'll use COIS as an example. They're taking a continuum for a week or 2 weeks. And then they come back, they've gone to all these different great courses and they come back fired up with all these great ideas. What should they be thinking once they've gone and they've learned new techniques? What should they be making note of so that when they call you guys, they could say, this is what I've done?
That's a great question, Art, and I'll take that one, Heidi. Really what we're looking for are case files. And we'll get into documentation in a little bit, but ultimately, if they think, gosh, you know what, I've done all these unique things, I kind of meet the criteria for the ideal dental candidate to take advantage of R&D, we're going to want to see their notes. And this is where they're going to document, hey, this was a new technique. This is something new I tried. These were the results, right? These are the different materials I applied. So hopefully they're taking detailed notes in those case files. And that's ultimately what we're going to use to help defend the R&D tax credit.
Okay, that's great. All right, go ahead, Heidi.
Yeah, so let me share a couple of different examples, and I'll go through these a little bit quickly because I'm hoping that you're taking some key points from this and starting to think about, are you really doing complex cases, or is it more of like, you're a general practitioner and you're doing a lot of routine things. So this example, let's say that you have a patient come to you, they're experiencing pain, and you examine them, and the cause isn't really readily ascertainable. Things come to your mind, like, is it nerve damage? Could it be, an existing device in their mouth that's not working properly? Maybe it's part of the wrong materials. Maybe the device needs to be rebuilt. So, you're thinking about, can I do this? So that's that uncertainty piece that has to exist. Then that whole process of experimentation, it has to be a systematic trial and error kind of, testing. And so that's where you're identifying different solutions. Again, different materials, layering different devices. And then, we talk over and over about this systematic process of experimentation, but I tell you, that's really where the IRS really wants to see, are you doing R&D? Because honestly, you have to show that this is not just normal stuff. This is something unique. One thing I do want to make a point of, very important in your industry, is that anything involving aesthetics, veneers, things like that, may not meet the smell test because there's a lot of regulations out there that talk about aesthetics, taste, things like that. It's just one of those really gray areas, so we just stay away from that. I have another example. Now this one is kind of a no-brainer, and this is what I typically see when we get some good credits. And, prosthodontists, right? They're very good candidates for this credit because of the complexity of their cases. One of the things that they do is they collaborate with specialists, right? And they have to build prototypes. Maybe they're using their CAD CAM modeling to model out what's this going to look like. And they're going through an iterative design process. Now, a lot of times these are the trauma cases, the severe diseased mouth. So again, you're seeing a pattern here, very unique things. And so you can read through these slides, and I think they're going to be provided for you. But the ultimate takeaway is that your activities have to be non-routine to meet the threshold.
Thank you, Heidi. And those are some excellent examples. So let me try and pull this back together and talk about, gosh, what is the ideal profile for a qualified practice? If you want to take advantage of the R&D tax credit, what does that look like? And I'm not saying you need to have all these things, but it really helps with, one, how big the credit can be, and two, the defense of the credit, right, if you're ever audited. So when we talk about activities, hopefully there's an in-house lab. Again, we're talking about a lot of non-routine stuff. So a lab certainly helps in that respect because you're getting a lot of unique product put together. There's in-depth diagnostic testing or data gathering. And part of this is, gosh, if it's in that case file, it certainly helps with the defense of the R&D tax credit. There's collaborative meetings with specialists on alternative solutions. And really the highlight here is this methodical plan involving a series of trials. And so kind of to circle back to Heidi's point, there has to be a process of experimentation. There's case law really targeted at the process of experimentation, and it has to be systematic. There's really, hey, we're developing a hypothesis and testing it. It used to be, gosh, it was simply an evaluation of alternatives, and that's really what the law says, but we're stuck with case law, and they've kind of expanded that definition a little bit. So that's where we live right now. In terms of costs, we talk about, gosh, it is a wage-driven credit, right? So, and a lot of these, a lot of dentists are, of course, S corps, right? And so there's a little bit of a game. how can we reduce our exposure to self-employment tax, right? And so we put a number out there, hey, 700K. Again, we're looking at, hey, how do you maximize the credit? How do you get enough benefit that it's worth your while? So again, that's kind of a target to shoot for. You have lab techs and assistants that are helping with that. You have prototype expenses, contract design expenses. Those are really kind of add-ons there. But again, given it's a wage-driven credit, we want to see some fairly high wages to make it worthwhile. If you go through all this work and you get a $3,000 credit, you're like, man, that was a lot of work for nothing, right? So we just want to make sure that you get enough benefit for the additional exposure on your tax return. Just kind of highlighting some of the key points here. So the credit's permanent, meaning, it's an annuity. Gosh, if you're a big dentist and you meet the requirements, you're doing a lot of non-routine stuff, you can chase this year after year. I think the other thing that I want to highlight on this slide is the Seymour Milling case or Seymour Milling case. Again, that's the one that really pushes the process of experimentation. And gives us that expanded definition that makes it a little bit tougher to qualify. So again, that's why we talk about, gosh, there has to be uncertainty, and then you're really documenting, hey, these are the different things we tried. This is the process we went through to arrive at the solution. And hopefully you're doing that in your case files. Again, it just it gives us great detail if you're ever audited in defending those credits. In terms of documentation, right, there's no specific record keeping requirement. The law is generally vague, which is a good thing and a bad thing. One, it allows us to be flexible in what we gather to defend your credit. On the other hand, it allows the IRS to be unreasonable and ask for things that maybe don't exist, right? So, the IRS is very aggressive in this area. They really, in our audits, documentation generally wins the day. So again, if you're thinking about taking advantage of the R&D tax credit, please make sure you have some good contemporaneous records, research notes in those case files, photos, consultation notes, lab results. Again, anything you can do to highlight the technical uncertainty and that process of experimentation. The last thing I want to leave you with today is, it's interesting. There's no specific guidance for dentists on the R&D tax credit. What they do is they provide a bunch of, fairly general law, right? And what we're experts in is taking that law, applying different fact patterns to your industry and to your business. So again, what we're trying to do is outline, hey, this is the best fact pattern for you if you want to take advantage of the credit. There's no case law in this industry. At some point, I'm sure there will be. So what we're seeing right now is that IRS pendulum swings back and forth. Sometimes we are going through without a lot of audits. What we're seeing right now is the IRS is getting more aggressive. They've hired additional folks, especially on the engineering front, and we're seeing more R&D audits. So again, if you have the right fact pattern and you have good documentation, the R&D tax credit's an excellent vehicle to save some cash. So, but again, hopefully you have some good documentation and a good fact pattern to make it fit.
Well, Jim and Heidi, that was an outstanding summary of how this works. I just want to make everybody aware that this is a tool in our tool belt as dental CPAs. Not everybody is going to qualify. But if you are doing, as they were saying, routine crowns and composite restorations and things like that, yet you may not qualify for this credit. But prosthodontists, if you have an in-house lab, if you're working on a new invention, it's a slam dunk probably. And again, the more innovation you can do. So when you go to your CE courses and you take your CE, make some notes, think about it, and then call us, because if you say, listen, this is what I'm doing, and this is the new type of a restoration I'm doing. I mean, Jim and Heidi and their team, they'll say, yeah, let's go for this. And the credit in California is bigger than the credit in federal. So guys, anything else you want to touch on? That was a great job. Thank you so much.
I think we're
Just
good, but
thanks for having us. Yeah.
yeah,
Well,
absolutely. Thank you, Art.
All right, we appreciate it. All right, guys, let's move on. I got a lot of stuff and not a lot of time. We might go a couple minutes over. I didn't see any. Let me see if I see I saw maybe a question here. Hold on. Oh, here's a question. Does the IRS usually audit the R&D portion only of a total tax return, or they audit the total return? What have you seen?
Great question. Generally, they're auditing the entire return, but they will focus on the R&D tax credit. Yeah, it's something. If it's out there, they're going to take a look and dig in.
Okay, that was the
And
question.
Yeah,
Go
and I
ahead.
think I just want to add, I think what we're really trying to communicate is that there's some industries that are slam dunks, right? That's what we put that up there, you know, manufacturing, things like that. And this dental area, little bit newer. So we just don't know what the temperature is of the IRS, of how they're going to feel about this. So that's why we're just, you know, giving you a lot of information on just be careful and make sure you substantiate it. But just wanted to add that.
Yeah, well, I'm very proud of this firm that I've merged with. I'm very proud of this R&D group and what they do. And you know, again, they're not going to put you in any kind of harm's way. They have told some of our clients, no, you know, just not feeling the love for your practice of qualifying for this credit. And I'd rather do that than take the credit. And 3 years from now, end up, you look and say, well, why did you do this for us? You know, so that's the deal. Guys, thank you so much. And you're welcome to stay on, or Jim, if you're going to turn into a pumpkin, but whatever you like, because you're back east a little bit, Midwest. Maybe you can tell me if I say anything wrong, which I won't. I got this all right. So, all right, guys, let's save you some money here. Let's save some taxes. Let's jack up that federal deficit. Now, the government doesn't need a whole lot of help in doing that because they're doing a real good job of it for themselves. Let's go to a 35,000 foot overview. How do we figure your taxable income? So we start with your gross income. There are more of these, but these are the biggies. The wages from your dental practice is taxable, and other sources. Your spouse works. You work maybe you teach at the university, at the dental school. Interest and dividend income, capital gains, your income from being a sole proprietor, a partner, or your K1 from your S corporation, from your dental practice, or maybe other K1 investments you have. Unemployment, which people have this year a lot. Social Security income is 85% taxable. And then distributions from individual retirement accounts and retirement plans. That's my gross income. I start with that. Then I have adjustments to income, things like IRA contributions, my non-incorporated doctors out there, retirement plan contributions, health savings accounts, alimony, a couple of others. Let's go to the next slide, Amanda, please. So we take our gross income, we subtract our adjustments. And one of those adjustments also is your self-employed health insurance if you're an S corporation shareholder. Remember, folks, if you're an S corporation, you have to call your payroll service. You have to call in the amount of your health insurance that you paid for the year. It's got to go on your W-2. Don't worry, you're not getting double taxed on it. Just make sure you do that, because if you just run it through your S corporation and call it insurance expense for your owner's health insurance and you get audited, they will disallow it. And my doctors that are, 55 to 65, your health insurance is running 15 to 25,000 a year. That's a big loss. So be very careful about that. We then subtract your itemized deductions. Only medical expenses that are in excess of 7.5% of your adjusted gross income are deductible. Most of you who have good medical insurance, or maybe you're on Medicare if you're over 65, you may not have that. State income, real and personal property taxes are limited to $10,000 per year. That was the Tax Reform Act of 2017. So we live in a high tax state, you get $10,000. Now, for California, you don't get to deduct your state income tax, but you do get to deduct more than $10,000 on your real estate taxes. So don't forget about that. Your home mortgage interest, deductible to the extent that you have a mortgage that's before 2017, that is mortgage of $1 million or more, $1 million or less, the interest is deductible. Anything after, I think it was December 16th of 2016 was the mortgage date, that you would then get only interest on $750,000. investment interest, if you have margin interest on your investment account, and charitable contributions. So that's how we figure taxable income. Let's go to the next slide. And then these are the rates of tax. And we as tax preparers, to save you money, we have the low, we look at playing with the rates. So look at this. These are the lowest tax rates you're ever going to see. So the first 10% of your taxable income is about, the first 20,000 of your taxable income is taxed at 10%. Then from about 20 to 80,000 is 12%. So if you can keep your taxable income at 80,000 or less, you're paying about an 11% effective tax rate. That's amazing. 80 to 171, we have a lot of our dentists fall in this range for taxable. That's 22%. A lot in the 24, 171 to 326.6. Again, you're never going to see rates this low, and we're going to talk about what they could be. And then when we get into the much higher incomes, taxable income of 326 to 415 is at 32, 414 to 622 is at 35, and over 622. So you got to be really making a whole bunch of money to be at 37%. Lowest marginal tax rates that I've seen in many, many years. Next slide, please. All right, guys. So let me start with the first sentence that's underlined so that we're really clear here. So I don't get emails or letters or texts that I am playing politics. I promise. I am not getting into a discussion of politics. Only bad things will happen to me if I start talking politics. So I will mention the word Republican and Democrat only as it affects the tax law. Okay, good. Now, as of right now, in January, we will, all things from everything we hear, we will have a president. We have a president named Joe Biden. We have the House of Representatives that are controlled by the Democrats. As of right now, we have a Senate that is controlled right now by the Republicans, 50 to 48. But you say, Art, in your civics class in college, they taught you that there's 100 senators. That's correct. On January 5th, there will be a runoff election for both Senate seats in the state of Georgia. Total anomaly. Okay, next slide, please. If the Republicans win one or both of these seats, they're going to have a majority in the Senate, and it's going to make it much more difficult for President-elect Biden and his new administration to pass sweeping tax legislation, which they have indicated they want to do. If the two Democratic candidates in Georgia win the election on January 5th, that will make it 50-50. What does that mean? Again, in the civics class, they teach you that in the Senate, if there's a tie of 50-50, the tie is broken by the vice president, whose name is Kamala Harris, who's a Democrat. What does that mean? That means that if the Democrats have control of the White House, the House, and the Senate, we may see the Biden tax plan or something similar. So I'm just preparing you for what could happen. Okay, next slide, please. If you go on to, if you Google Biden tax plan, you can read all about this to your heart's content. One of the things that they are talking about right now as a dentist, you pay Social Security tax at 12.4%. Half of yours comes out of your salary as the owner doctor. The other half comes out as the employer's portion. 6.2% withheld from your wages and 6.2% matched by you, the owner doctor. But you only pay Social Security up to $137,700 for this year. That's the current wage cap. Okay, what they are, what President-elect Biden is proposing is a donut hole. That's what they're calling it. They're saying, okay, you'll pay the 12.4% on the first $137,700. Then you pay nothing from $137,700 to $400,000, but everything over $400,000 is going to go back to 12.4%. So if you have $1 million in wages, you're going to pay an additional tax of 600,000 times 12.4% is about $75,000. That is what is in the Biden tax plan. It will change the let me try this again. This will change the top tax rates. Remember, we said $600,000 is 37%. It will drop it down to $400,000, and now the top rate will be 39.6%. If you read the Tax Foundation's literature, if you Google Tax Foundation, they have a lot of really interesting stuff if you like this stuff. And what they're saying is that the big losers in all of this, as far as it's going to cost you more money, are people that make more than $1 million. The people that make 400 to $1 million, 400,000 to $1 million, they will pay more, but it's not going to be astronomical. It just depends on your situation. But here's a key that you want to be aware of. It would tax long-term capital gains and qualified dividends at ordinary rates if your income is over $1 million, and eliminates stepped up basis when you inherit property. I have a client that just came to me, and his mom passed away. They inherited a property 3 years ago that was worth $2.8 million, and they sold it now for 2.4 because of COVID, and it's a rental property and it's all legitimate. We have an appraisal. They're going to get a $400,000 loss. Well, they're going to eliminate that step up in basis. And if you have a big capital gain, for example, what if you sell your dental practice? You could end up paying tax at 39.6%. I'm not suggesting that that there's anything you can do about this. I'm just telling you what could happen. Be prepared. So what that means is, if you have a rental property with $5 million of gain in it, you're probably not going to be able to put it on the market today, December 9th, and sell it by December 31st. And with everything that's going on in Washington, folks, the number one priority for our new government is going to be the coronavirus. It's going to be getting those vaccines out to hundreds of millions of people and making this national nightmare that we've lived now for 9 months, hopefully put it behind us. So I don't know if tax legislation is going to happen. We talked to our legislative analyst in our firm, who's very knowledgeable, Mel Schwartz, and he said he doesn't think we're going to see tax legislation till the summer. And usually they don't increase taxes retroactively. They usually do it as of the date of the enactment. So it's just something, if you might want to go on and read about the Biden tax plan and see what he's got. If we do have a Republican Senate, that doesn't mean that President Biden and the Democratic agenda isn't going to get forward, because they'd only need to flip one or two. But you just need to be aware that this is out there, folks. Okay, next slide. So also gives his plan a temporary increase in the child tax credit, which is really cool, by the way. If you have adjusted gross income of under $400,000 and you have children under the age of 17, you get a $2,000 per child credit. Another reason to do some of the things we're talking about as we go along here, okay? The Biden tax plan would take it up to a refundable $3,600 per kid credit, and then $3,000 for up to age 17. Now, a refundable credit is paid as a refund even if you don't owe any taxes. There'll be an increase in the child and dependent care credit, which is going to increase it significantly, like 3 times. He has a $5,000 credit for informal caregivers, a $15,000 credit for first-time home buyers, and a credit to ensure that rent and utility bills don't exceed 30% of your monthly income. So there would be a lot in a tax plan if President Biden and the Democrats were able to pass legislation. Just kind of letting you know what they have in mind. Next slide, please. All right, how do we save taxes? What do we do? So I told you earlier in the webinar, folks, that your incomes, especially if PPP continues to be non-deductible. If it's deductible, you guys are all going to be buying me lunch because you're going to have a lot of money in your pocket. But if it's not deductible, we're in a year that we have to save money. We have to, we want to knock our income down. My philosophy as a tax person for 40 plus years has been, I want a tax deduction today. I'll worry about tomorrow. I want to save money today. Number one, what can you do in the next 22 days before December 31st? Number one, equipment purchases. I will tell you right now that Henry Schein, Patterson, Benco, Pearson, all the dental supply companies, they are gearing up. They're waiting for you guys to call and say, hey, I heard this guy Wiederman give a webinar on December 9th, and he said that I can write off 100% of that new digital scanner or the CEREC or the CBCT machine. And you can if you check the boxes here. But they're ready for you. They can put a dental operatory in a week or two. They're ready. They know this is coming. So any equipment that you buy, now you notice it says place in service in capital letters. The equipment has to be placed in service before December 31. That means in a state of readiness. So if you're building out a new office, folks, and you want to kind of look at your tax situation, maybe you place in service, maybe you're putting a 6-chair office together. So you put 3 chairs in and you get them up and running on the 28th of December. And maybe you save the other 3 chairs for next year if you're going to be in a lower tax bracket by all the write-offs you get. And you place those in service January 5th. You need to take pictures and document. If you're doing a remodel and you're just telling your accountant, oh, it's in service, what I would recommend you do, make sure that you have the packing slips, pictures of the installation, maybe even, if it's a dental chair, clean your spouse's teeth and take a picture of it in the new dental chair and date stamp it December 28th. If I show that to an IRS auditor, I'm good. I get 100% bonus depreciation in 2020. If you spend $175,000 on a CBCT, $130,000 on a CAD/CAM machine, you get 100% write-off. For California, there's no bonus depreciation, and you're limited to $25,000 under Section 179. So you're not going to get as much of a bang for your buck for California as you are for federal. Now, here's the one piece of information that you need to write down. If you go to your CPA and you say to your CPA, hey, I listened to Art, where am I at? Oh my God, I'm up. I got this HHS money. PPP is not deductible. I want to buy a CAD/CAM. I want to do that forever. I want to buy a laser for $90,000. I want to do whatever you're going to do. Here's the one question you must write down tonight, which may be worth the whole price of admission. You say to your CPA, I went to this webinar. I want to spend $100,000. I'm going to go get a loan from the bank or from Patterson or Schein, and I'm going to buy this equipment. Do I have sufficient S corporation tax basis in order to write the equipment off this year? That's all you have to do. And if the CPA looks at you like, like it's a foreign language, give me a call, okay? So let's go to the next slide, because I think I have an example here of how this works. Art Wiederman, DDS Inc. and S Corporation, member FDIC. Dr. Wiederman's practice grossed $1 million in 2020, and he had a net profit of $300,000. S Corporation's tax basis at the end of 2020 was 0. I took salary out of my practice of $120,000, and I took distributions from my S Corporation, money out of the corporation, of $180,000. I bought a CBCT machine on December 20th and placed it in service for $120,000, and I took a loan of $120,000 from my local bank. Since I added $300,000 to my basis, so your basis goes up when you have income. Your basis goes down when you either pay salary or take distributions. Okay, so you're going to have $300,000 of basis, $300,000 of distributions and salary. Your basis, if you take all the money out of your corporation, is going to be 0. And what does that mean? That means that your equipment guy is going to tell you, oh yeah, you can write this off, bonus depreciation, no problem. And then you go to your accountant in on March 15th, or you come to me and I say, hey, we got a problem, Joe. We got a problem, Dr. Smith. You don't have basis. Do you lose the deduction forever? No, it just carries over to the next year until you do have basis. Next slide, please, Amanda. All right, so since I don't have basis, what do we do? So what we can do is we can either take some of that distribution money and put it back into the corporation as if we never took the distribution. Capital contributions of personal money basically qualify as basis. So I can create basis and I get the deduction. Maybe you have a bunch of basis and there's a bunch of money left in your corporation because maybe you came back real strong and you didn't have a lot of staff costs while the pandemic was going on and the office was closed. Don't take any more distributions this year. Create basis and you'll get the write-off this year. That's how I want to cover that. So let's go to the next slide, please. But that is a great way, folks. Buy equipment. It has to be placed in service. If the equipment rep says to you, oh, all you have to do is put a down payment of $1,000 on it and you can write it off, we'll deliver it to you January 15th. You will lose the deduction for 2020. So you don't want to do that, okay? You really don't want to do that. And if you get audited, they might go back and you might be past the statute of limitations. So be careful about that. But equipment purchases are a thing that you can do in the next 22 days to save tax money. All right, let's talk about retirement plans. Mama bear, Papa bear, and baby bear, Mama bear, Papa bear. Baby bear plan is the simple IRA. Okay, now if you haven't set one up yet, it's too late for this year. You had to have set it up by October 1st because you have to give certain legal notices to your employees. You can fund with a spouse on the payroll, which all of you should be looking at putting your non-working spouse on the payroll, or even if you have a working spouse on the payroll, if they're doing things to help your practice, and you have to justify that. So you can put away about $30,000 to $35,000 if your spouse is on the payroll with a minimal contribution to employees. You only have to contribute to employees who are actually deferring money. It's like a 401k, except it's a little dialed back. So if you have no employees that are participating in this, you don't have to give a dime to them in an employer contribution, and there's no IRS administrative reporting requirements. Okay, for those of you who are looking and say, gosh, Art, you're right. My income is up and I'm doing well and we're back to normal and we're getting new patients and things are looking up. And again, remember, folks, I want you to think about one thing. I'm going to digress for a second. Number one, with all luck and God bless the folks that have done this, this week, the FDA should approve the first round of vaccines. It is very realistic from what we're hearing that a large part of the American public could be vaccinated by the summer. What that means to you is that there's 15 to 25% of people who normally go to the dentist, who we all know are afraid to leave their house right now. They won't go to the market. They won't go visit their kids. They won't go anywhere. And they certainly won't go to the dentist. Once we have a situation where people are confident that this horrible virus is no longer a threat, but it's more like the flu, which is what we're all hoping for, that 15 to 25% of people are going to come back to your dental office. Because I'm not a dentist, I don't play one on TV, but I do know this. People who don't go to the dentist, do their dental problems get better or worse? They get worse. So they're going to have to come and see you. So you could end up with a really good 2021. Again, nobody knows what's going to happen, but we're certainly hopeful. Okay, profit sharing plan. You can set up a profit sharing plan before the end of the year. All you need to do is to go to a pension administration firm or a brokerage and set them up. Please don't do pension administration with a brokerage firm. Please don't do pension administration with a payroll service. I can spend an hour telling you nightmare stories of people that have done that and they're sorry. Go to a third-party pension administrator. Your CPA can refer you to one. I can refer you to one. You can put away up to $57,000 plus $5,000 if you put a 401k component in if you're over 50, plus $19,500 for your spouse under 50, 25, that should be $26,000 if you're over the age of 50. and you would likely be having to fund $5,000 to $15,000 for your employees, and you'll have administrative fees for IRS and Department of Labor compliance. That's what most of you have, is you have what's called a safe harbor 401k plan. If you want to save money for this year, you've got a bunch of money saved up. Same question. If you're planning on funding 50, 60, 70,000 to a pension with next year's money, check with your CPA. Same question as the equipment. Do I have proper S corporation basis? If you've got that money and it's grown in your account for this year, you're fine. For those of you who are sole proprietors or partners in partnerships, you don't really have to worry about it. If you're a partner in an S corporation shareholder as a partner in a partnership, you do have to worry about it. That's where your CPA comes in. The last thing is a defined benefit pension plan. We set these up for clients who are as young as 40 to 45, and the minimum you should be planning to fund is 100 to 400,000 or more. You need to be committed to this plan for 3 years. You can't just do it for 1 year. You can't call me up and say, Art, I'm getting 700 grand, I'm selling my practice. Can I just dump it all in a pension plan for 1 year? Can't do that. Doesn't work that way. So what you want to do is plan it out. Here's a great strategy. Dr. Wiederman is 58 years old. He's going to work 3 more years or 4 more years. He's planned it out. Stock market cooperates, real estate cooperates, he's going to retire. So what we do is we set up a defined benefit pension plan, and we can use it with the profit sharing plan. And what we do at the end of the day is we fund maybe 100, 120,000 for year 1, 2, and 3, but we have the pension actuary set the formula so that in year 4, when Dr. Wiederman sells for 700,000, that we can dump a bunch of that money into the retirement plan. So we've used that strategy with a couple of dentists in the past 2 years, and it works magically. Next slide, please. So retirement plan contributions. Folks, if your income is going to be the same, I tell you what, I am the person who I want you to be thinking about at night, who is going to annoy you and say, save money, save money. I have seen too many dentists who get to the point that they're 48, 50, 52 years old. They're living their life. They're putting their kids through school. They're buying the next house. And then the back goes out, or the neck goes out, or the shoulders start to hurt, or the hands. I get carpal tunnel. I can't do this anymore. Can't hold a handpiece. So save money early, okay? Absolutely save money as soon as you can. Tax deductible, earnings grow tax deferred. If you don't have a plan, you got to set it up by December 31st. Too late to do a simple. You have until the due date of your tax returns, including extensions. And by the way, folks, I'm going to go and digress here. For our clients that are listening, and we've told you all this, if Congress doesn't do anything with any kind of stimulus or PPP stuff, and they just kind of kick the can down the road, we're going to be extending your tax returns because we think that they're going to do something, because there's enough bipartisan support and enough of these trade groups that are pushing real hard to change this law to make them deductible. So we'll keep you posted on all that. Contributions are fully tax deductible, and earnings on the amounts that you contribute and grow in the plan are tax deferred. For most of you guys, if you put a plan together, it's going to save 30 to 45% in income taxes, federal and state. My threshold of pain is when you go to the administrator and you tell the administrator, hey, administrator, tell me how much I get and how much my employees get. Well, Dr. Wiederman, you're going to put 100,000, you get 30,000, they get 70,000. I'd rather take the money and pay the taxes. But if we just did a defined benefit model for a doctor. They're going to get, I think it was about 400,000 for themselves and about 15,000 for their employees, because they had really young employees. So if you make a lot of money, you got a lot of money set aside, you can do this, and your employees are to some extent younger than you are, the defined benefit can work really nicely. Let's go to the next slide, please. All right, here's my favorite. All my clients want to write off 275% of their automobiles every year. Well, what can I do? What can I get away with? Well, you're supposed to be able to justify your auto expenses. If you get audited, here's what happens. The auditor says, Dr. Wiederman, I want to see your log of your driving for 2 months. Give me April and give me October. They'll pick the 2 months randomly, or they'll say you pick the 2 months, and you're going to have to justify. There are some clever ways to get around to and from work, but mostly to and from work is not deductible. Driving to the lab, driving to your accountant, driving to CE, which nobody's doing a whole lot of any of that right now, is tax deductible driving. If you buy a car that is under 6,000 pounds GVWR, ground vehicle weight rating is what that means. You will find that in the driver's side of the front door, and also in most owner's manual, it will tell you, look it up. It's not GVR, it's GVWR. I believe there are 2 ratings, okay? If you buy a car under 6,000, you get $10,100 of depreciation in the first year, plus $8,000 of what we call bonus depreciation. State is different. You have to multiply that by the percentage of your business usage. My recommendation is you don't take 100%. And we have a saying in the tax world, pigs get fat and hogs get slaughtered. Don't be greedy. You know, if you can justify 80% business, take 80%. Don't take 100%, because the government's immediately going to say, how did you do that? Now, there's one way that you can. You have 2 cars. Drive 1 car from home to the office. Get out, get in the other car that's at the office all the time, and drive from the office to wherever you're going. If you want to do that, you can claim 100% business usage. Is that practical? I don't know. Okay. Now, if you buy a car that's over 6,000 pounds, F-150, an Expedition, a Tahoe, big automobiles and trucks. Okay. Again, in the owner's manual on the driver's front door, you can take 100% bonus depreciation. It's the same thing as buying the CAD/CAM machine, or buying the laser, or buying the CBCT times your business usage. So if you buy a car that's $50,000 and you take 80% business usage, you can take a $40,000 write-off. Now, if you're an S corporation, what do you have to have? You have to have S corporation tax basis. If you do, you can do that. So, do you want to drive a car that weighs 7,500 pounds? That's up to you. If you want the tax write-off, you can do that. If you're audited, you're going to need to justify your business percentage, but that's another thing that you can do before the end of the year. And I guarantee you, the car dealers are gearing up for the people that are going to their CPAs. They're in cahoots with Shine and Patterson. So the car dealers are in cahoots with Shine or Patterson. I'm just kidding. They know you're coming. They know that people are going to buy cars before the end of the year. Even though we're not driving as much as we used to, gosh, with any hope and prayer, we will get back to that. So next slide, please, Amanda. All right. How about we put the kids or the grandkids on payroll? Now, I have 2 adult children, ages 26 and 31. And my 31-year-old happened to be here, and he helped me so that I was all red before this started. And now he helped with the settings and the pictures. So the fact is the real reason we had children, folks, is to teach us all this computer stuff that we never learned in the 80s and the 90s when we were younger like they are. But now we can put them on the payroll. Why would we want to put kids or grandparents on the payroll? Number one, we might want to fund a college education fund. I have a client years ago, he told me, Art, I funded $10,000 a year in salary to each of my 2 children. I said, well, how much do you have now? Well, they're graduated from college, but we have $250,000 in each account. Well, have you told the kids they're adults? Oh, no, I don't tell them about that. Whatever. Save the money for college. Save the money for a car for the kid when they turn 16. Save the money for, maybe you're going to save the money that you put in their account and say, hey, this is a down payment on your first house when you get to be 25 or 30 or whenever you can do this. Under the Tax Cuts and Jobs Act of 2017, they almost tripled the standard deduction to $12,400. So what about a grandparent, by the way? A grandparent, why do we fund our grandparents? Because maybe they're living on a fixed income. Maybe they didn't save very well and you have to help them out. That's what we do to take care of our parents. You might put them on the payroll. Maybe they can help you with marketing. Maybe they can help you with website. Maybe they can help you stuff envelopes to send out mailers. These are all the things to consider. So you need to set up an employee personnel file, put your child or parent on the grandparent or grandparent at a fair hourly rate. Next slide, please. So here's an example. Dr. Wiederman's son, Nathan, and by the way, that is his name. He's my 31-year-old, who is a computer expert. Has been hired to help the practice with the website, marketing, and he does administrative and office work involving the marketing. If I can justify that Nathan is making, performing these services, if I go out to a dental marketing company, what am I going to have to charge? What are they going to charge me? They might charge me $10,000, $12,000 to do this stuff. Okay. Based on what Dr. Wiedemann would have to pay to another professional, Nathan works enough hours to justify it, then we can justify the payment. We put him on W-2 payroll. So if I pay Nathan, he pays $0 in federal income tax if he's a student, or maybe he's in college. Okay. I wouldn't do that for a 1 or 2-year-old. We'll talk about that in a second. So if I'm in the 37% marginal maximum tax rate, folks, that's going to save me $4,588. Now, would I do exactly $12,400 in salary? No, because the IRS knows what the standard deduction is. But you need to have a story. When you go to the IRS, folks, they have a job to do. They're not evil people. They're not bad people. They have a job to do, which is to follow the tax law. And if you tell them, hey, here's the stuff that Nathan did. Nathan designed my website. Let me show you my website. If they have Wi-Fi in the building, which sometimes they don't, I've had that happen in IRS audits. But show them what he did or what she did to justify all of these the money you paid. You have 2 or 3 kids, that's $12,000 in taxes in your pocket, folks. And by the way, that's plus state taxes. So you could be at a 50% marginal bracket. If your income is over $600,000, every dime that you can put in a retirement plan, pay in equipment, pay to the kids or the grandkids, and it's going to be grandkids too, by the way, to your parents or grandparents, is going to probably save you close to 50% on the dollar. That's a lot of money. Next slide, please. All right, here's my favorite, buying versus leasing a car. So if you buy a car, let's go back to the car, you're going to take depreciation each year. Now, if you buy the 6,000 pound car, you're going to get a much bigger bang for your buck by buying the car than by leasing the car. Very important to understand that. Okay. So if you're the type of person like me, now I have owned 4 cars in 40 years. And I own a car for a long time. My wife Lynn said, hey, we're going to go ahead and we're going to paint the back of, you're going to paint your car. It's going to cost $2,000. I said, over my dead body, if you paint the car, it will stop running. That's how I feel. Okay. Cars don't get me excited. They get me from point A to point B. But if you're the type of person who doesn't drive a ton of miles and you always want to have the newest model every 2 or 3 years, you should lease. You're never going to have equity in a car. Okay. But buying is going to give you larger and faster write-offs than leasing will. So if you say, well, what if you said about a car, can I lease a car in December? You can, and you get the lease deposit, whatever they require, plus maybe 1 lease payment, and that's your write-off. So you want to lease a car, you want to buy a car if you want a bigger write-off. You want to lease a car if you don't care about the write-off, and if you just want the nicest car that you can get every 2 or 3 years, and you don't want to spend $50,000 for a car. Next slide, please. All right, capital gains and losses. So how do we generate a capital gain and loss? Well, we can do it in several ways. We can sell stocks, capital assets, mutual funds, real estate, your dental practice. Now, the tax rate for federal purposes, for basically if your taxable income's under $80,000 or your gain is under $80,000, Anything under $80,000, if your taxable income's down there, can be taxed at 0%. So if you have a low income year, maybe you started a practice this year, maybe your practice didn't do really well, whatever it is, and you've got some gains, and maybe your income is going to be really low. Maybe you got this R&D tax credit. Well, no, that the R&D tax credit is not going to affect it. That's going to affect the tax, not the income. But you have a big medical expense. You have a big charitable donation you made. Your income is going to be down. This would be the year to seriously consider generating capital gains. So what you want to do is sit down with your CPA, see where you're at in December. And what I always do when I'm doing the interview and I'm doing the meeting is I say, all right, here's where you're at. How much in capital gains do you have this year? Because remember what I told you about capital gains are on the table if we get the Biden tax plan. Okay. So, what do we do? Can we get a bigger write-off? Can we get a lower tax rate for these capital gains? Can we be at 15%? What if next year you're selling your dental practice and you're going to have income of $800,000? This may be the year you want to sell your stock or something like that, because you'll be in a lower capital gains tax bracket. So if you've already sold assets at a gain and you've got those gains are already baked into your tax situation, see if there's anything in your investment portfolio that's at a loss, stocks or mutual funds. Tech stocks are killing it, but growth stocks are not. All right. So if you've sold assets at a loss, then you can basically, let's say I sold assets at $50,000 loss. Well, what if you have a gain this year? Okay. Now the loss carries forward, but I certainly would, what if it's a stock where your investment advisor says, we bought this stock and it's done really well. Zoom, for example, which is the platform we're on today. Okay. And, I think it's time to sell it because I think we've really taken all the gain that I feel comfortable. Sell it now. And there you go. If you sell a stock at a loss, remember, folks, you can't buy the same stock back for 31 days. That's called a wash sale, like wash your clothes. Okay. There are instances where you can sell capital assets and generate a 0% tax rate. We played with is about a 44 line form that tells you how the capital gains tax is computed. It's very complicated. And the computer software does it beautifully. So, talk to your CPA. It requires the use of tax projection software, which we and other CPAs use to determine the right mix. Next slide, please. So capital gains and losses. Itemized deduction. So I had a doctor come in. He had a situation where he personally had out-of-pocket medical expenses that were not covered by insurance of over $100,000. Not going to get into the situation. Obviously not going to give the name of the doctor, but that's what happened. So what do we do in that situation with medical expenses? If they're over 7.5% of your income, it's probably a 1-year anomaly. Maybe you had some cosmetic work done. I don't know. That's not technically, I'm sorry, not cosmetic work. I'm saying you had a surgery that's not covered or anything like that. Okay. Then you want to take a look at this and say, if I'm in this year where I'm over 7.5%, you want to pay everything that you can. My brother is a perfect example. My brother had eye surgery and it cost him $11,000. And he was laid off of his job for 3 months. And so I said to him, his name is Michael. I said, Michael, I want you to gather all of your medical expenses. And I want you to look at what you're going to spend in the first 3 months of 2021. What if you have a bunch of chiropractic visits planned? What if you are going to have a surgery planned and you were going to do it in January and your out of pocket's $2,000? Pay the out of pocket this year. And you can put it on a credit card, folks. You can do that with medical expenses, and you can do that with charitable donations. If you put it on a credit card, but you don't pay the credit card till next year, I get the deduction. You get the deduction this year. Okay. Bunch as many of your medical expenses into 2020 as you possibly can, because you might not get those medical expenses. Okay, next slide, please. Here's one. So appreciated stock. We all have some of that, or a lot of us do. Never, if you want to give appreciated stock to charity, never ever sell the stock and give the money. Here's the example. Dr. Wiederman likes fruit, so he buys stocks with the name of a fruit in it. That's my investment philosophy. If it's got the name of a fruit in it, it's great. And this year I started at the beginning of the alphabet, and I started with A, and I bought a stock called Apple. Apple's done pretty well, right? That's accountant's humor. What can I tell you? Apple stock has a gain of $100,000 because I bought the stock when Apple came out with the iPhone 1 back in the 1800s, okay? If I sell my stock and I pay federal and California tax of $30,000, about 30% in my bracket, because I'm going to pay maybe 15 or 20% capital gains federal and about 9 to 10% state. That leaves me $70,000 to donate to my favorite charity. If I donate the stock in kind to my favorite charity, as long as I've held the stock for over 1 year, which is very important, you got to hold it for more than 1 year, a year and a day, you're going to get a full $100,000 tax deduction. Big deal. There are also donor advised funds that you can put money into today, and you can have them doled out over a period of years. Talk to your financial advisor about that. So donate appreciated stock to charity. That's a way to get a tax deduction this year. Next slide, please. Here's another game we play, standard deduction. Similar conversation to the medical expenses. Remember I told you that they tripled the standard deduction to $12,400 for single? Well, for married, it's double that, $24,800 in 2020. So let's think about it, folks, and we see this in our practice. Since we're limited in California or in the United States to $10,000 in state and local income taxes and real estate taxes, right? Maybe you're in your 50s or 60s and you've paid your house off. Interest rates are at historic lows. I mean, if I have a $600,000 mortgage at what, 3%, that's $18,000. If I have a $300,000 mortgage, it's $9,000. Your mortgage interest is going to be low because the rates are low. And maybe you don't give a lot of money to charity. Charity is a very personal thing, and you give what you give. So if you're below the standard deduction this year, let's say you go to your accountant and you add all these things up, and I'm at $20,000, don't make any charitable donations this year. Bunch your charitable donations into a year where you're going to push yourself over the $24,800. Next slide, please. So here's an example. Dr. Wiederman doesn't have enough medical expenses to receive a benefit. He's at a maximum of $10,000 for state and local taxes. His home interest is $7,000, and he's given $3,000 charity. So I'm at $20,000. So I'm below the standard deduction. So it makes no sense for me to make any additional donations for 2020 until I get to under $4,800, because everything under $4,800, I'm going to get the standard deduction because I get the larger of the standard or the itemized deductions. What you might consider doing is bunching your deductions for charitable donations into 2021. Maybe you're talking a donation to your dental school or to your church or your synagogues or your religious organization's endowment fund or building fund. You might make that donation of $10,000 this year, because remember, if I put $10,000 in, I'm at 20, that gets me to 30, right? So I'm over the standard deduction. If you're over the standard deduction this year, maybe you did make a big donation. Bunch all of your deductions before the end of the year, because if next year you don't have a lot of charitable because you gave 10 or 20 grand to the building fund at your church, then what's going to happen is next year you're going to be at the standard deduction, which will go up another $1,000 or something like that next year, and you won't get it. So you want to plan on bunching your deductions every single time to make sure that you're over the 24,800 or saving them for a year. Maybe you plan for them. Okay, next slide, please. All right, and this is the last thing that we have on here, and we're right on time, okay? On September 9th, 2020, the California Governor Newsom signed Senate Bill 1447, AB 4047, which established the Main Street Small Business Hiring Tax Credit, provides financial relief. So if you are hiring anybody, okay, between December 1 and January 15th, so the window is right now. If you have less than 100 employees, which is going to be probably all of you, unless there's somebody on this webinar that has 30 practices. And if you have experienced a 50% decrease in gross revenues from April till June of 2020, as compared to the gross receipts in April to June of 2019, which could very well be many of you on this call, because remember, dental offices were shut down pretty much from the 16th of March until anywhere from the 15th of May to the 15th of June. You can apply for a tentative credit reservation. And there's the link down there that I've provided for you. Go to that link. It'll give you all the information. If you've hired somebody, it's $1,000 per employee. That's $1,000 in your pocket, folks. So anyway, I do tax planning in 4 hours on a lot of these webinars. I felt it was really important tonight. Let's go to the next slide. I think that's about it. Here's my information. So I want to share a couple things, and I'll take some of the questions here so we can finish up pretty much on time. So, this is a year like no other. And I want to tell you that first of all, I am indebted to the dental profession, who for 36 years has embraced me as an advisor. I love doing these webinars. I love helping people. I did 30 to 35 of these webinars on PPP and HHS, mostly PPP, in April, May, and June, and it was a labor of love. I have a very good friend whose name is Gary Takis. Some of you might know him. He's one of the best dental coaches in the country. And Gary, if you've ever heard him lecture, he does a thing on legacy. And he talks about, when he talks about what's your legacy going to be, he shows a video of Led Zeppelin at the Kennedy Center being honored for the Presidential Achievement Awards, I think, or whatever they call it there. And they played Stairway to Heaven. So he talks about legacy. My legacy is I feel is helping the dentists of Southern California and beyond in trying to help you to get to where your financial goals are. If I can be of help to you, my team can be of help. Heidi, if Heidi and Jim can be of help on a credit, give us a call. We'll be happy to help you. If you have a great CPA, work with that CPA, talk to them, him or her, about all the things we talked about tonight. All right, let's look at some of these questions. Let me see what I can do here with some of these questions. Let's see, will it be a recording of the seminar? Yes, now my understanding, folks, is that all 6 of the local dental societies we're going to get them all copies, and I believe they're all going to put them on their website. All these webinars that we're doing, these 19 webinars through next year, are going to be on the websites at Eide Bailly, which is www.eidebailly.com. One doctor is a plethora of information. One, appreciate if you could re-listen. Absolutely, you will be able to do that. Let me see if I can scroll this down here. Question, can I hire my wife to work as a new employee for credit? For the credit. You know what? That's a good question. I don't know. I haven't gotten into the weeds on that. I would suspect not. I would suspect that there's probably some exemptions in there, but I'm not sure. We can check that out for you. And very kind. Let's see. Oh, one more thing. Let's go to the next slide. I think they put this in here too, folks. I do a weekly podcast. Some of you have been kind enough to say you listen to it. It's called The Art of Dental Finance and Management. If you want to sign up and subscribe and tell your friends, we have great guests. We had Dr. Kathleen O'Loughlin as someone on the podcast, who's the executive director of the American Dental Association, things like that. So, do listen to it. We have a lot of good information. This week, I'm going to be really talking about some of those things, the HHS and the PPP. Okay, a couple more questions. Do you recommend putting a practice in a living trust? That's a question for your attorney. The stock is owned by the dentist. I think they do put that in there, but I would ask my estate and trust attorney about that. But I think that there are some legal ramifications, which I'm not qualified to advise on. Can you or should you, as an S corporation, invest in stocks, mutual funds on a business level? There is a special investment tax. They don't want you using the S corp as an investment vehicle. There are certain limitations. You can have a little bit of investment, but I would not put hundreds and hundreds of thousands of dollars into an S corporation. What else do we have here? I think that was it. Let's see. Okay. So I think that was all the questions. Let me look at the Q&A again, make sure I didn't miss anybody. I think we got everybody. All right, Amanda, I think we're good. I think we're done. God bless all of you. Thank you for taking your time. Our next seminar is going to be, I believe it's January the 13th. Let me look at my, quickly, let me look at my my calendar here. It's going to be, yeah, January 13th is going to be our next webinar, and it's going to be with Kira Dent. It's going to be a killer webinar about what to do in your dental practice. Please sign up. Again, if we can be of help, here's all of our contact information. And Miss Amanda, you did a great job. Thank you to you and your wonderful team at Eide Bailey. I'm so blessed to be part of this group. Really, really blessed to do this. And let me look here. There was, let's see, I think that was it. So anyway, if you have any questions, take down our numbers, give us a call. We'll be happy to help you. And for all of you, thank you so much for listening. And God bless all of you. Please stay safe and healthy. Have a wonderful holiday season. And by the way, folks, the last thing I'm going to tell you, and if you listen to my podcast, you'll know, I have a 5-word saying: failure is not an option, and it is not. The dental profession has come through this as strong as any profession, any business group that I know of. And you guys have done a wonderful job of managing and taking care of people and making your offices safe. Think about it. I was talking to somebody the other day. There is not one case of COVID-19 that I have heard about on the news, whether this came from a dental office. No, the dental office is one of the safest places you can go. And we have to remind our patients of all that. We have to remind our patients, folks, that they are, that health begins in the mouth. And if we can have a healthy mouth, we can have a healthy immune system, which fights this horrible, horrible virus. With that, I will bid you good night. Thank you for your time. Thank you for listening. God bless all of you. And we'll see you on the next webinar. Okay, take care. Bye-bye.